Good afternoon. Thank you for joining us for ROK Resources Drilling Update. ROK Resources trades under the ticker symbol ROK on the Toronto Venture Exchange, ROKRF on the OTCQB, and they also have freely tradable warrants with a strike price of 25 cents with a March 2025 expiration. The company has had an exciting 10 months and was finally able to get back in the field drilling. With us today from the company are Cam Taylor, Chairman and CEO, Bryden Wright, now President, congratulations, and COO, Jared Lukomsky, VP of Land and Business Development, and Lynn Chapman, CFO. I'll turn it over to you guys to discuss the press release, and then we will follow up with Q&A. Please enter your questions in the Q&A box. As always, the presentation may contain forward-looking statements. Welcome, gentlemen.
Thanks, Jeff.
Thank you, Jessica. I'll do a quick introduction of what ROK is as a company, just for those that are new to the company story, but we won't spend a lot of time on that. We'll focus on our Q2 press release and our recent operational updates. So we'll just take a look at the outline of this company. We're expected to end the year at 4,500 BOE a day. That production is focused in Southeast Saskatchewan primarily, with a second core area in Kaybob in west central Alberta, about 3 hours northwest of Edmonton. The NOI forecast for 2023, $38.5 million, and exiting the year at a little under $17 million of net debt. We've been really busy for the last 24 months on acquisitions and divestitures. We finished up the last of that in May of this year, paid our term debt off, and we're able to start focusing on optimization of the company's assets, and just got back to drilling in July. We also have a lithium property within our core area in Southeast Saskatchewan that's always been characterized as a free option on the lithium for our shareholders. We'll provide a little bit of an update on that. And then I think key focus for us in this last year was paying that debt off and getting the balance sheet tidied up. So that's sort of a look at the snapshot of the company. We have a long history together as a team for the last 15 years, building and selling private companies, but now really focused on a bigger asset base, better quality, lots of infrastructure, strength in our core areas, and have been moving the company forward. Much larger production base now, clean balance sheet, and a lot of running room on our drilling locations. Just a quick overview of the cap table, sitting at 215 million shares outstanding. The bulk of our dilutives are one batch of warrants, 113 million shares. They're publicly traded, strike price 25 cents. Important to recognize they expire 18 months from now, and they bring in $28 million roughly of capital at that point in time. Another thing we like to focus on is that the management and directors of the company own 17% of the company. We view this as an important part of our philosophy running these companies, is that we're heavily invested, directly aligned with the shareholders. This isn't about employment for us. This is about managing our investment in alignment with our investors. I'm just going to use this slide, which is the company profile, corporate guidance. I'll let Bryden step in here and bring everybody up to date with respect to what our Q2 press release was about and what our recent operational update was, and how it fits into this progression in the company. Go ahead, Bryden.
Yeah, so Q2 was highlighted basically by the tail end of our acquisition and divestiture package. So you can see our Q1 at 4,100 barrels a day, and Q2 dropped to 3,300. And so, we had bought some assets from Whitecap. We had sold, basically did a swap with them And then about a month, 2 months later, we sold our Weyburn unit. And so with that, our production dropped. We cleaned up our balance sheet significantly, deleveraged. But of course, when you're selling 450 barrels a day of fairly flat production at Weyburn, you'll see a production decline there in the short term. So our thesis for this year was always to, take care of that M&A side of things over the first half of the year. And the second half of the year is going to be focused solely on organic growth on these opportunities, on these assets that we've now, consolidated. So we've done that. We started our program in late June. We've drilled 5 wells over the course of Q3. You'll see, the press release we just released, 3 of those are on production. Type curves, we're producing above the type curves, albeit it is early. We only have, 2 of them are right about an IP30, and the third one is just shy of that. So, we're cautiously optimistic on how those are going to trend, but so far so good. Of those 5 wells, we drilled 4 Frobisher wells. These are all Southeast Saskatchewan, 4 Frobisher wells and 1 Midale well. 3 Frobisher wells are on production with those other 2, 1 Midale, 1 Frobisher to come. So we should have that all producing by the first week of October. And, moving forward into Q4, we have another 5 well program planned, operated. Again, Southeast Saskatchewan focused, Midale, Frobisher, a combination of the 2. And, looking ahead to year end, we're pretty optimistic that we'll hit our target of 4,500 BOEs a day. Pricing has obviously not recovered, but increased recently. The last month has been pretty nice as far as the WTI mechanism, and hopefully gas will kind of follow as we move into Q4. But all in all, really nice start to the program. One thing I will note, of the 5 wells we drilled, they were all in different operating areas. So we weren't, focusing on one area. So we have been trying to spread that out. Again, looking to grow our reserve base and our production base and expand some of these plays. So we're looking to exit the year again at 4,500 BOEs a day. We do have a little bit of gas shut in Kaybob. We expect that to come back on in October. And hopefully, produce throughout the rest of the year. It was a pretty up and down summer, and I would say even late spring through now out in northwest Alberta with the forest fires and a lot of things impacting our production out there. So we're really hopeful that Q4 is that first quarter where we have everything back online.
Thanks, Brian. Just to look at some of the results from the consolidation of assets. This is the core Southeast Saskatchewan area. We do have lands off of this map sheet, but this would represent a big part of our 3 acquisitions. And we are now one of the dominant players with respect to infrastructure pipelines within this area. On the west edge of this map is the Steelman area, where several of our competitors, Whitecap Surge, have been drilling a lot of great wells. This is the beginning of the Frobisher trend we chase. All the way down to the southeast is that Frobisher edge that is our focus area for the Frobisher wells. South of it is the Midale that has extremely high oil in place numbers, and we're utilizing multi-well drilling as well as fracking to get to that. But now, because of these acquisitions, we're sitting with pipelines and facilities in place for all of our drills. For the most part, we're able to plumb directly into existing infrastructure. So very strong position we have in our core area now. Most of this is tied in for gas, so we can capture and sell gas as well. I'm going to let Bryden just talk about our location inventory and a couple of our type curves on the Frobisher and Midale.
So yeah, our locations are consolidated primarily in Southeast Saskatchewan. We do have a number of upside locations and inventory in Kaybob, but the focus currently is in Southeast Saskatchewan. In a fairway, Mississippian fairway, both Frobisher and Midale that we've drilled probably in 3 of the last 4 companies prior to ROK. That was the area of Saskatchewan that we operated and really focused our activity in. And so what we did with our acquisition of those Whitecap assets is really bolster our inventory, especially in the Midale. And we've been working, over the last few months, adding locations in the Frobisher as well on that land base. So we're sitting with about 115 locations identified and booked in these areas specifically. There are additional locations in some of the other areas we haven't listed here. And as we drill locations and as we add to our PDP, we're adding inventory as well. We're trying to balance, the conversion of PUDs into PDP, but also looking to add locations to the inventory. So as far as the Frobisher and the Midale go, I'm sure most of you listening, have heard of the Frobisher. If you follow, Southeast Saskatchewan oil and gas, it's probably the most prolific play from an IRR and from a payout and netback standpoint. It's a light oil play, conventionally drilled, very quick payouts. Geologically complex in a lot of areas. There's high risk areas, and you're looking for these kind of smaller pools, and that's what we've been able to put together. Within this asset base, and also historically in previous companies. So, the Frobisher is we model it at 110 barrels a day IP30. That is about 15% below our reserves type curve, and so far, at least in this recent drill program, we've been able to exceed those rates on average by about 30 to 35% so far. And again, it's early, so we don't want to get too far ahead of our skis, but things are looking up, and we're going to continue to focus on those Frobisher plays going forward.
And those are single leg?
Single or dual.
Dual.
So it just depends on which member of the Frobisher that you're drilling. The reservoir quality, the H kind of thickness between them. If you have to
thickness, yeah,
by single or dual. Yeah.
Okay.
The Midale, so we've been able to, actually our most recent well that isn't on production yet, we ended up drilling a 3-leg well in what we had previously identified as a frac candidate. And so, where you have both the Marley and the Vuggy, we've done both, but, historically over the last, say, 10 years specifically, the Midale's been fracked, and that's today around $2 million a well. We were able to exploit 3 members by 3 legs and save, near $500,000 with that. And, I think based on drilling results, it looked pretty attractive, and, we're cautiously optimistic on that. So the slide that we include on this deck is a fracked slide, or a fracked well economics. But again, the nice thing about the Midale is you have an attractive EUR, slightly longer payout, but it has that water flood upside as well, and a longer reserve life. So we really like the balance of the Frobisher and the Midale assets that we have.
Thanks, Brad. One of the things that is important for us to highlight is in May, when we finished finally acquiring the third big asset to consolidate our core area, we were able to sell off a non-op asset and pay off our term debt. So we've been able to, on that federated co-op, purchase $58 million net purchase price. We've sold off $74 million non-operated.
I think it's worth noting too what price you sold your non-op, the Weyburn unit, your non-op assets for, as compared to what your market cap is, and how much production you gave up, which was minimal.
Handle that answer, Brian.
Yeah, we sold, well, Jared might have the exact number. We sold our Weyburn unit for, I think it was 44 million.
Call it $45 million in totality.
Yeah, it was a $45 million sale price, and that was about a 450 barrel a day asset. And obviously at that time, it was probably close to 50+% of our market cap, I guess I would say. I can't remember what we were trading at then, but 450 barrels a day out of 4,000, but accounted for 50% of our market cap. And again, those that are familiar with the Weyburn unit understand, it's a sought after asset and a fairly low decline, hence why, there was value. But we thought at that time it was a very good piece of business to do. really deleveraged the balance sheet and provided us that growth capital that we wanted.
Thanks. It's put us in a position where we had a very clean balance sheet and been able to focus in on our operational details within those properties and now get back to drilling. We will end up the year at a little under 17 million and expect to be at 4,500 BOE a day by year end. So very happy with how that string of 3 acquisitions has gone, and basically had most of our money back out and have a nice clean balance sheet to move forward with now. We still believe we're a bargain valuation. We're one of the few junior growth companies. Clean balance sheet, extremely high growth rate right now. Lots of good inventory to keep that growth going. And as we get a little more visibility within the marketplace, hopefully we'll clean balance sheet, lots of growth potential. We'll begin to see some recognition in the share price as well. Hedging contracts, previously under our longer or bigger term debts, we ran a 2-year hedge book. We now are hedged out 12 months for 75% of our declining PDP production. Importantly, though, all of this new drilling is currently unhedged, and so we're benefiting from a really strong price on the bulk of our oil production. Lithium, we continue to present this to our shareholders as a free option on a tremendously valuable resource. We've Lynn can correct me on this. I think we're maybe at about 1.4 million all in cost-wise. We got into this play very early, but we've now drilled the 2 best lithium wells in Canada by quite a margin. A lot of players trying to move projects forward at the 75 to 80 parts per million. Our wells have tested in the 200 plus range. Our secondary project is at 148 parts per million. So the best resource that we've seen in Canada to date, primarily focused right now on getting a PEA out. Because of some of the partners we're working with on the downstream side of that, we expect that to come out maybe 3rd, 4th week of October when we can finally finalize the numbers and get that out. Really looking forward to that. That'll translate our reserve report into dollars and cents in the economic assessment. Also moving forward on 2 pilot tests of our brines and have some of our initial pilot testing moving through a small scale refinery. So a lot of momentum on this play right now. The key objectives for us going forward here is to figure out how to get this holding that ROK Resources, the oil company, has. How do we create 2 things? One is recognition of the market value of it, and secondly, put it into a position where we can get that value into the hands of our shareholders, either through a sale or a dividend or something. But I think we have 4 to 6 months of work ahead of us executing that plan. So just before we go to questions, just sort of summarizing what we think we are here. We're very high quality assets. A lot of time accumulating a really strong core area where we're a dominant player in an area that we've worked aggressively for 15 years and know it well. Kaybob, a multi-zone area that our expectation gas prices improve a year from now. There's a mix of oil and gas there, and we see strong growth. In the meantime, on the back of our Southeast Saskatchewan oil, we see strong free cash flow generation and good drilling list, good reserve report, and a clean balance sheet. So we're very excited about the position we find ourselves in today. And now we're going to focus on drilling and organic growth. It's handed back to you, Jessica, for some questions.
Okay, great. Thank you very much. Good overview. And congratulations on everything you guys have accomplished. You've been definitely firing on all cylinders. Speak to the debt. Fantastic job you've done getting it down. What is the size of your RBL right now, and what are the restrictions on it?
Lynn, you want to handle the line?
Yeah, absolutely. So we have a current line available to us of 22.5 million. Restrictions largely relate to our hedging requirements, as Cam had spoke to earlier, where we have to have 75% of our PDP production as presented on our reserve report hedged out for a rolling 12 months. So we continue to monitor pricing and what's available in swaps and collars, et cetera, in terms of making sure that we're constantly in line with that. Other than that, we do have to monitor our debt to cash flow, but with where our balance sheet is at this point, it's not even a question of concern for us in terms of keeping below the ratio thresholds that they have laid out for us at the moment.
I think the only other significant restrictions relate to share buybacks, dividends.
Yeah,
that's not a set of options that we're free to work on right now. That'll obviously be something that we'll work on with the bank as we move forward, but currently we're restricted from that.
That's correct. Yes.
It's a question that strategy we've discussed, and question that does come up, but you're limited obviously until your bank line review. And when is your next review?
November.
Okay. And you on that, is there been any chat on what your production, or let's say cash flow, has to be before they lessen the hedging requirements, or nothing yet?
Yeah, we don't have any line of sight on that. That'll be a discussion in November. I think they're going to be looking at what does our borrowing line look like, how much of that do we want to access, and all of this improvement in WTI will change the answer considerably as well. So, we'll look forward to that in November, but no guidance right now. Okay.
On to more exciting stuff. In your most recent 5 wells that you drilled, how many offsets do you think you have generated? And do you plan to drill some of these or focus on some other areas with the remainder of your drill program for this year?
Putting me on the spot in terms of offset and numbers.
You don't have to answer it. That's okay.
So what we've tried to do is balance. So two of the areas I will say were unbooked areas out of the 5. So that was areas where we had no reserves attributed to the lands. So, we're looking obviously to get that PDP on the books in addition to, a handful of locations, I would guess. And then the other 3 wells have been conversions of probables, actually, one PUD to PDP. So we should be able to book additional locations off of each of those as well. So, that's kind of how, our land base is pretty consolidated. That being said, it's not a resource play by any means. It's a lot of these, small pool structures that we're drilling, and you drill a well on the flank and you're able to book wells offsetting it. And you're doing that and you're putting these all together to create this, really attractive package. And so that's how we treat it. And again, it's about, for us this year, it's really about growing that PDP as well as our 1P.
We have already entered a process of licensing 5 additional wells off of this package of 5 that we've drilled. So it's created an immediate action item that we're licensing and getting ready for drilling.
And these weren't even in your Whitecap. These weren't even any of the Whitecap assets you bought. So you haven't even drilled those yet, right?
No, in fact. In fact, the 2 of the wells were on the first asset we picked up the day oil went negative, and we picked up an asset for nothing, and we've been able to move that from about 100 BOEs a day to 400 over the course of 2 years. And to answer your question, the Whitecap lands, we're actually going to go drill the first 2 wells out the gates here in October, are going to be our first wells on that land base.
Okay. And those are 2 Midale wells?
Yeah, those are 2 fracked Midale locations. We actually previously owned the one section, and we drilled the offsetting wells, and the wells, the one in Alameda to the west was offsetting again some of our lands in Villanova, so we know it really well.
Perfect. Okay, so then I'll skip over the other one because you probably don't want me to ask you what area you're most excited about. So we'll just go past that. Oh, well, that's an even better answer. Your forecast to drill 10 wells this year. With the strength in oil, can you add a few more to the program for this year?
Yeah.
And will you?
Yeah, we've had that conversation for sure. I think we've had that discussion with the board as well about, increasing our capital program through Q4. I think that's an option. I think if oil prices remain strong, you may see us do that. We also have some partners where we're non-op positions of say 50% that we may have a well being drilled with them that is currently not on the books. So, I think between that and maybe increasing our operating budget, that's definitely an option.
I think a big important part of that answer is related to that Whitecap acquisition, and that sort of falls into areas that we're very excited about. We've finally gotten through the full interpretation of all of the seismic that we pulled over in addition to those assets, and we're out licensing a set of wells there now. There's a township where we see potential for 15 to 16 of these Frobisher locations, and we're out licensing 4 initial locations to test that area. None of that is in our budget, so we're unclear whether that'll execute in the end of the program in Q4 or into Q1, but definitely creates, none of this area is booked. It all has existing infrastructure and pipelines and production, but none of these locations are booked, and so good growth opportunity for us in that area.
And each of those 16 locations potentially identified, there's about 4 separate independent areas. So four mutually exclusive areas of kind of 4 wells each. So, it's not, one wouldn't be contingent on the other working, which is nice.
Okay. And I guess, again, we have to, you highlighted, but again, these aren't resource plays that take a lot of technical expertise. It's important that we focus on your history in this area, and you've been so successful. But it's not like anyone can just go and punch down 8 wells per section. It's quite complex, the geology. So, it speaks to your abilities. I know a big focus of this year and next are going to be converting PUDs into PDPs. It's pretty early to give any kind of numbers on that. Do you have a sort of a percentage that you'd like to see?
With a 10 well program, we'll be adding 10 wells into PDP, obviously, and hopefully say 60 to 70% of those will be adding additional locations offsetting. There's going to be some infills that we're drilling, of course, and like, for instance, our Midale wells, our fracked Midale wells, they are a little bit lower risk locations that will not have offsetting bookings. Perhaps one of them will, but then on the other hand, we'll have say 3 or 4 Frobisher wells, 2 of which will be unbooked completely, looking to offset. So, if we're looking for a percentage, I think say 6 or 7 out of 10 will be adding locations, is kind of our hope. And then moving into 2024, that's, really contingent on obviously how some of these newer plays work out. The one Cam just spoke to, we've picked up some really strategic crown land that we hope to drill perhaps Q4, but most likely Q1, a little bit more of an exploratory play. So those are some exciting ones.
Okay, so we've got sort of some development and exploration to look forward to. And so just on, speaking of your drilling inventory, with what you have in place right now, and I know it's going to change as you start drilling even more, with what you have right now, what do you think you could grow this asset base to on a production basis?
I think
go ahead, Jim.
good. Yeah, there's a combined answer there. The Kaybob area we view as the oil plays are now coming into the price deck where that's accessible. Gas, we don't really see that gas complex picking up till November of next year, but at the right gas and oil price, we can carry that area up to probably 3,000 BOE a day. So the Southeast Saskatchewan assets, we have the ability to accelerate drilling. It's just a question of what kind of reserve life index we want to keep out in front of that asset. So it's no problem for us to push that up to 5,000, 5,500. But it's really going to become this balancing act of what kind of reserve life index. And we're actively accumulating land. We've been active at land sales, doing small acquisitions, growing that base. So, sorry, a bit of a non-answer. It's not a hard number, but it's really striking that balance between, do we want to maintain this 12-year reserve life index? What's our target there, and how do we accelerate the production in combination with that?
Okay, so that brings me to my next question on decline rates and growth. So with your new production, you had a pretty low decline before. I think it was about 26%. Am I right on that?
22.
22? Okay.
Yeah.
Before you started drilling. So what is the ideal growth rate and ideal decline rate? So you're not getting on a treadmill, but still adding a lot of growth.
Yeah,
I think that out. Really?
No, I think so. 22%. We view that as fairly low, given kind of the
your growth company
wells we're drilling and the fact that we're growing. So I do see that increasing. It's each one of these wells would have anywhere from a 40 to 70% kind of year one decline on it. And, obviously you have some that outperform that dramatically, but, I'm just kind of speaking on average. Both a conventional Frobisher well and a frac Midale well have a pretty high decline rate in year one. So if we're adding, 15 to 20 of those a year, I definitely see our corporate decline rate, moving up toward that high 20s, kind of 30% range. I think that's manageable. We're doing other things to try and stem that. We just began a water flood project at Benson, which will, provide some longevity in the Midale there. We have some other pools that are identified as water flood candidates. One actually up in Kaybob. So there's things that we can do to try and stem that. But as a growth company, that's essentially you're gonna be in that higher bracket of decline rates. So it's something that we actively will be managing, and it really just depends on the rate of growth that we choose.
I think if we're just trying to pluck numbers out of the air for discussion purposes, if we were sitting in this oil and gas price and we targeted a 20% growth rate, that would fit the cash flow. The more that our price complex goes up, the more ability we have to, we get shorter payouts, we get to recycle capital quicker, we can maintain a higher growth rate. So price complex that we're facing really dictates a lot about what growth rate we can hit.
Okay, one question here from the audience. We've already talked about hedges, but would you hedge more than you're required to, given oil's above 90 currently?
No, we'll match our hedging with our bank debt requirements. Probably target for us would be to be fairly heavily hedged in the first 6 months and have a moderate hedge for 6 to 12 months, and probably start moving into collars as opposed to these swaps. That's probably where we're headed in the hedging strategy.
We currently have 1,300 barrels a day, 1,350 barrels a day hedged of oil, which now accounts for about 60% of our actual production. So we have over 800 barrels a day of unhedged production right now, and obviously the bulk of that is flush. We foresee that growing over into Q4, and through Q1, at which point that's when our hedging PDP base will be revisited with the bank, and that'll be reestablished, if that makes sense.
And
so
really, I mean, that's a really first, you really only want to hedge to protect your capex for the most part, right? And then
yeah,
the rest is. Yeah.
For us, it's debt and capex, right? That's what we want to protect. And obviously our debt levels aren't high. Debt to cash flow sub 0.5. So we're in a good place there. So really it's, we're bullish on the price of oil going forward. And I think, we want to maintain the bank requirements, but I don't think we go beyond that.
Okay. And just quickly, given you are adding a lot of production here quickly, what is your sensitivity for every dollar change of WTI to cash flow?
Yeah, so Lynn and I were talking about this recently. It's about, so for every $10 change, and this is for Q4, keep in mind. So we still do have 60% hedged on oil.
So it's not a simple.
It's just not as if we were an unhedged company, it would be a lot more dramatic, right? But It's about $1 million a month in revenue change for a $10 change in WTI. So what's that? 100,000 for every dollar, I guess, and that's revenue. So on cash flow, you're probably looking at $750,000, maybe over a quarter for that $10 change, something to that effect. Okay. So again, it's meaningful, but at the same time, because of those hedges, the more barrels unhedged,
you don't have as much torque. Yeah. Let's see what. Yeah. Now, let's see. Mark. Let's see. Okay, I'll just go to a couple of the audience questions before I continue with mine. Shareholder ownership, besides management owning 17%, major owners of shares. We've got a lot of high net worth, a few funds, and the rest would be retail. But long term, larger book retail for the most part.
Yeah, I think so. Our institutional ownership isn't super high. We have a decent chunk of retail. There's also a large percentage of kind of, friends, acquaintances, people that we know that have invested early with us and have come along, and would kind of hold their shares long term as well.
That tight group of long-term shareholders is probably in the 30+% range. And I would characterize the rest of the holding is a lot of it's dominated by some high net worth individuals with energy expertise. That probably characterizes a lot of our big investors, and then a pretty healthy retail mix across the last third, probably.
I agree. Yeah, it's your shareholder base is very solid, and certainly has a lot of. You guys have a lot of support. Given, you didn't have a lot of news for 9 months, but they, stuck by you because they know what you can deliver. Okay. And your op costs were up in the second quarter. I think that was mainly due to power. What are you seeing on power prices? I mean, I hear they're crazy right now.
There was a variety of reasons for that. It was a transition with new assets coming into the mix. We sold some lower OPEX Weyburn production. We did have a number of non-capitalized workovers that were probably double what we typically would have in a quarter on a per BOE basis. So if you look at the previous year when we incorporated the FCL asset into our company, it took about a quarter and a half to really kind of get that digested, get those assets digested, all of the new, operators and employees and things like that, and start to understand the assets really well. So there is a bit of a transition period where operating costs historically, at least for us, have been a little bit high. And so we see by, Q3, we should see, I think there might be a little bit more of a lag into Q3, but by Q4, we expect our operating costs to kind of come back in line with where they were previously.
Okay. And of course, you'll have economies of scale as well. So that will help.
Yeah. And, adding production, always helps with that as well.
Yeah. Okay. Now, one from the audience. Excellent results and explanation of the company focus. Well done. I know the market dictates share price, and we all know it's below fair value. But do you have a ballpark for NP? I would guess you can use your NPV 10 number of a fair value. I don't know what it depends what people want to use for.
We know in April when we did our pro forma reserve report, like if you're looking at PDP, or a 30 cent a share PDP company, and hence our focus on solidifying that piece of the pie. So, I definitely think we believe in our assets, and we believe that we're going to realize the value of those assets for our shareholders. And so, I don't have a number to provide fair market value today, but I definitely think we're moving in the right direction to hopefully get a bit of a re-rate and start to see, that reflected in our share price.
Yeah, I think
sorry, go ahead, Cam.
We look at the cash flow multiples that we're trading at and sort of where we sit on that spectrum, that we feel that's a low range right now, and there's some higher multiple potential down the road here. So we'll just keep working on these pieces. We've cleaned up the balance sheet. We've got a great drill program going, and we'll expect those multiples to start rewarding us as we get that word out here in the fall.
Okay. And then the same, have any companies sent out feelers on buying you, which of course I'm sure there's, and your company or significant assets, Kaybob or Saskatchewan?
Yeah. We've been in space working with all these competitors and other players for a long time, over 15 years. And we know all of them, always having conversations as a buyer, a seller, all of these things. But, I really think with the cash flow multiples that we're looking at here, this isn't a serious time to be thinking about selling anything.
I was going to ask on the A&D market, how is it right now? Is there a lot of stuff for sale or?
Not today, but we believe there's going to be quite a bit coming up in potentially Q1 of 2024. There's still lots of little private stuff. We did a little $400,000 acquisition not long ago. Just drilled one of our better wells on it here in our last program. Lots of that kind of stuff that we work away on. But bigger packages, we're expecting some stuff, if not at sort of right at the end of the year, but maybe in Q1. So we
good. So I won't book Christmas vacation again this year. Is that what you're telling me?
No, I'm not forecasting anything. Just hearing that there's going to be product on the market, and I expect it. I think you're safe for Christmas. I expect these things to hit the market in Q1, and so maybe your spring break might be at risk.
Okay. I guess you don't want to mention the vendors. Okay. I'm just looking at the audience questions. Follow up to a question here. Being that they can't do buyback because the bank line, is the plan to use the coming funds from the warrant exercise in 2025 to pay off the bank debt and operate debt free going forward? I don't think that's an efficient use of capital myself, but you have to have some debt, I think.
Yeah, I'd prefer to look at it as optionality. We have a lot of options. Like when cash comes in a year and a half from now, as an example, on warrants. The ideal situation is we've got some great properties to spend that on drilling. If we're heavily undervalued, we can use that on things like share buybacks. I'm not going to pretend to know what that environment looks like then. So I think we're just going to try to leave as many really smart options on our plate, so when the time comes, we can select the best one. But too many, I would have to ask you 12 questions about oil price and our multiple like that.
And I didn't bring my crystal ball with me today.
Yeah,
so
that's right.
Okay, one more question on the oil and gas, and I want to get to the lithium stuff. So just our latest trends on drilling costs and rig availability. I mean, I don't think that there's any shortage of rigs out there.
Yeah, we've been able to access, we basically had a rig running in Saskatchewan. So we have a really good crew on this rig. We have about 3 service rigs doing a variety of jobs and operations for us. So we've had no issue there. A little bit tighter in Alberta, but we haven't been really active out there. But my Alberta team's been telling us that it is a bit tighter. So you got to be selective about how and when you utilize the rigs there. But then as far as costs go, we haven't seen the big continuous increases that we saw last year. So it's definitely settled out, and we're still seeing costs, let's say on average 20% higher than they were 5 years ago. But it's all very manageable.
Okay. So let's go to lithium. As we've seen some big players enter the, like Exxon, Chevron, et cetera, enter the brine lithium area. It's becoming more and more talked about, and there's certainly been some more recent research lately that brine lithium is likely more economic and more feasible than mining. But this jury's still out. But considering I'm not as smart as you, Bryden, could you sort of give us a simplistic description of how you can process why brine lithium is, how it's relatively more easily processed than a mining operation?
You know what? I'm not as smart as Cam, so I'm going to let him answer that.
Okay.
Yeah, I think there's really 3 sources of lithium going forward. One is these spodumene mines, and they have very long permit times. They're expensive. So I think, for example, some of the Goldman Sachs work on that last April, they're saying that that's going to be a dangerous one in terms of cost per ton. The traditional one, a lot of people call them brines, the South American brines out of the salt flats and that type of thing. That would sort of be the traditional one that is going to benefit a lot from these new direct lithium extraction technologies. And that was the heart of that analysis by Goldman in April, was that they believe direct lithium extraction technologies, the DLE, is going to really drive expansion of supply and a lowering of costs. So on the traditional salt flats of South America and a few of them in the US, there's a big move forward with that technology. But this third piece, the part we're involved in, is the brines from downhole and the kinds of things we've been doing, drilling wells. And we've in our particular area, we just have a massive salar that's buried, and we have to drill and extract the brines that way. The DLE technology is the key to that one. And there's been so much money spent on that tech over the last 4 years. You're seeing big players like Koch Industries and Exxon each dumping $100 million into owning resources in that downhole brine business. All of us, including ourselves, believe that 2024 is going to be the transitional year where we see all of that technology actually getting built at scale and coming towards that final production. But the kinds of numbers we're being offered by the tech providers, it's looking like that's going to be economically competitive with the salar brines. And so, I think it all revolves around this DLE tech and how it's matured now finally after a lot of wasted money experimenting over the last 2 or 3 years with some lost leaders. People have dialed into some DLE tech that's working well, and it's going to get commercialized. And big companies like Exxon and Koch have done that work, and they're starting to lay down dollars buying properties like ours. We think the 2 really good areas are this Saskatchewan Duperow, where we're seeing 150 to 250 parts per million, and we don't have H2S and contamination to deal with. And then down
it's just like drilling a water well.
Yeah, it's identical.
What it is.
We drilled our last lithium well, put an ESP and pumped a bunch of water up the hole to test it. We moved the rig 2 miles over to our Benson property and drilled the first well of this program, and we've outfitted it with an ESP. Then we'll bring brine to surface. It's for us, it's an identical process, using all the same people, all the same rigs. The only difference is that in the building on site, instead of a 3-phase separator and heat treater, et cetera, we have a DLA extraction unit. So yeah, it's, we think this area of Southeast Saskatchewan and then the Smackover will develop as the two best areas. And that's what we're laying our bets on.
Okay. And we should hear a lot more news over the next few months on that.
Yes.
Okay. Well, it's certainly an exciting area. And then when can we expect your 2024 guidance?
November 20th?
Yeah, plan is to release that November 20th alongside our Q3 results.
Okay. You think I missed anything?
I don't know. No,
I think we've got it all covered.
I think that's pretty good. I think we've taken a lot of questions from people. We've been pretty quiet since we paid off our debt, and we've been through a really tough market through the summer, et cetera. People are asking when we're going to start telling our story a little more aggressively, and I would loosely say that those plans are in place. We expect sort of starting mid-October through to the end of the year to put quite a bit of effort into investor communications and making sure people know the story. It's been a very busy 2 years, but this company, the framework of this with the assets and the balance sheet is incredibly strong, and we'll definitely get out and brag about it a little bit in the fourth quarter here. Super.
Yeah, we've got a pretty fulsome schedule, I think, for the next 6 months, really. So
yeah,
it'll be a busy time. Yeah.
Okay. Well, if anyone else has questions that they didn't get answered or want to speak with management directly, just email me at jessica@adcap.ca. And thanks very much for your time, guys. Congratulations. The story looks fantastic.
Great. Thank you.
Thanks for having us.